Mark, when we asked you to come on, we had no idea the NASDAQ was going to do what it does. That's how it sometimes works in TV, but that's how we're going to start. Jim's saying it's insane. Do you think it is?
I don't think it's insane, but it's definitely a little bit frothy. But that's nothing new. The tech sector has been where extreme valuations have been ignored. Cash flow is going there from investors, but it's also where commerce is going. There is a link that's somewhat justifiable when you look at what you do during the day. You noodle around on Facebook and you're shopping on Amazon and you're searching on Google and you're still relatively working from home and staying from home. You're pulling up Netflix. It's not a manufactured craze that's delusional. Whether or not the valuations are legitimate, that's for time to tell, and that's what markets will give us. In fact, yesterday on your network, Mark Cuban was saying the tech bubble wasn't just a 6-month or a 1-year bubble. It was a multi-year bubble. It went on for years. So you don't pull out of what's working well just because it may be a little overvalued. This could have years to be overvalued and delivering results for investors.
And that, I get your point, Mark. It's like, it's a certain demographic, but you're ordering your Amazon Whole Foods on your iPhone, picking it up in your Tesla before you come home and watch Fauda on Netflix at night. I get that. But is it something else at work here with these names and something I've talked about called market structure? And some people think I'm insane. Maybe I am. Others agree that you've got these stocks that are just running all these ETFs. All the ETFs pretty much have the same stocks as their top holdings simply because of their size and also their interest. You need people to buy ETFs. They are a product after all. And as long as people just keep putting a little bit of money into their, retirement accounts, a lot of it's going to go to passive investments, and valuations may not matter to some point because people don't even look.
Yeah, and then you throw in the Robinhood effect to what you're talking about, which is where all the ETFs are weighted and including the FANG names or FANG plus, whatever metric you're going to use. The indexes control them. The big mutual funds are buying them. And nobody wants to not be a winner. So all the money managers are participating in it. And no matter where you turn, you're going to own these stocks. And whether there's 6 or 7 names that are running 25% of the S&P 500, it doesn't seem to matter to investors. But look, as a money manager, you almost can't blame them.
Unless, Mark, they go down. Unless they go down, which, to your point, they may never go down. But we saw that they went down in March. And that's the risk. I'm not saying they're going to go down. It's not my job. All I'm saying is that when you got guys like Jim, who've been, doing this for 40 years and been writing and seen everything, calling this insane, if those stocks roll over, is there any way the market can hold up? Even if 494 other stocks go up, those 6 could bring the market down, could they not?
Well, those 6 can bring the market down, and I would never say that they're not going to go down or that tech can't correct. What I'm saying is, as an investor, being allocated in that space has made sense. So I'm not going to be the first one to say I'm the smartest guy in the room and today's the day to pull out. That's where I'm coming from on that. If what I really want investors to do is to be broadly diversified and somehow hold their nose and still invest in some of the value side of the equation. If you're a long-term investor, if you're nearing retirement, you don't want to say, well, just because some transports or industrials or medical technology hasn't been participating like the sexy FANG names, I don't want to invest in them until they go up. That's not the right way to invest. You want to look at both sides of the equation. You want to own some of the value names that have trailed or lagged. We had good reports this week from the investment banks. So if you don't like financials, and I generally don't like financials, as you know, I don't like banks. I think Morgan Stanley and the Goldman Sachs of the world came in with great earnings. They're on the value side. They can diversify you into financials. Visa, MasterCard can get you into the financial space. So as an investor, find ways to broaden out and go for stocks that are beaten down or undervalued or selling at low multiples and barbell them with continued tech that has been working. That's how we're structured, and that's what I think makes sense for investors.